Three valuation mistakes stock market investors make. I know many of you guys enjoy such educational content whenever I explain how to value certain stocks, like in this one when I talked about how to value growth stocks like Palantir and SoFi, and the biggest mistakes that value investors make while valuing those stocks. And in this one, I'm going to do something very special, and it's very, very basic actually, but I'm going to talk about the three biggest valuation mistakes that stock market investors make. It's a lot of basics, but it's very important stuff that many of you guys make, and I know those things when I get feedback in my comments around why I didn't talk about this, or why I'm not doing this the right way, or why whatever. So I'm going to explain all those things in this video, and those kind of videos, they don't get a lot of views. So if you do enjoy it, all I'm asking is please press the like button and let me know what you think in the comments. Now, this is the first one, and it's one of the most common things that I see amongst new investors is using a DCF on every stock. So us as investors, a lot of us are lazy. Let's be honest. We want something that's easy. We want something that's simple. We just want one answer for every single problem. But investing isn't so simple and isn't so easy. And you can't really be successful in investing if you want something simple or if you have a short attention span. So using a DCF on every stock is pretty much the lazy way to do it. Why? Because you can't value a quality, like a compounder like Costco, the same way you value an unprofitable company like ASTS Space Mobile, or you want to value a stock like HIMS, which is a growth company, or you want to value a bank like JP Morgan, or you want to value a turnaround stock like Nike. You can't value all those stocks the same way. Each stock requires a different metric. So unprofitable companies require more of a price to sales ratio, and you have to think how much they can grow in sales and put a multiple on the sales. It's not much about the DCF. For turnarounds, it's a little bit different. You have to adjust for a lot of things in their free cash flow. For a company that's not growing, you have to use the free cash flow yield plus the revenue growth, assuming everything remains the same. For growth stocks, a lot of times you have to use earnings per share growth. So the truth is, using a DCF on every stock will cause you to miss on many different opportunities, or if you depend on those websites that give you like an automated DCF that will tell you, oh, this one's overvalued, this one's overvalued. This is all a scam. It's not accurate. And I tested those things. And if you look back at stocks like Meta and stocks like Nvidia, the DCF always says that the stock is overvalued, but the stock just keeps on going up. So maybe DCF isn't really the best way of doing it. It's the easy way. But investing is not easy, and every stock has to be valued differently. And if you watch my videos on YouTube, you realize that I value every stock differently. I don't do the same valuation on every stock. Sometimes I use price to sales, sometimes I use price to earnings, sometimes I use free cash flow yield, sometimes I use price to tangible book value per share. With banks, you have to use tangible book value. So it's different for every stock. And if you watch my videos, you can learn the different ways of how I value every single stock. But that's a big one. The second one, which is my favorite one, and that's a really big one, is skipping because of high debt. So everyone wants a clean balance sheet. All of us as investors, we love the company that has no debt, has a lot of cash. We feel it's safe. We feel it's a quality company and all these kind of things. But the truth is, because everyone loves a clean balance sheet, those stocks, they trade at a premium because of the balance sheet. Now, if you're trying to look for bargains, many times you can find a bargain if the company has some debt, because many investors skipped it because it has a lot of debt. And that's the biggest mistake investors make, is that when I talk about a stock, let's say Pepsi or Verizon, they say, but what about the debt? Why you don't talk about the debt? The company has $30 billion in debt. They don't have a lot of cash. They have so much debt. Now, this is the big mistake, is skipping them because of high debt instead of looking at their ability to repay the debt. That's the big one with retail investors. So if I talk about a stock like Pepsi, Pepsi has $37 billion in long-term debt. Total debt is like $60 billion. They have $9.2 billion in cash, and investors tell me, Pepsi has a lot of debt. Why you don't talk about the debt? Don't you think the debt is a concern? Well, the truth is, guys, that a lot of companies, they would be stupid not to operate with a lot of debt. Pepsi would be dumb not to operate with a lot of debt. Verizon would be dumb not to operate with a lot of debt. If Verizon had no debt, I wouldn't buy it. I'm like, the management is dumb. They should be leveraging the balance sheet as much as they can. Why? Because they have a predictable business model. If you have a recurring revenue business model, you have to take advantage of that by taking on a lot of debt, enhance return on equity, and create value for long-term shareholders. Many of those companies, they take debt at 2% rates and they buy back stock and the stock goes up 8-9%. Or they do other things that can return more than 2% a year, which is their interest. So in this case, with Verizon, with Pepsi, Procter & Gamble, they should have a lot of debt because the business model is so predictable. But looking back at the debt situation with the companies, and what you should really do is look at their free cash flow. And the free cash flow for Pepsi for 2025 is around $9.5 billion so far, okay? $9.5 billion. Now, after you look at the free cash flow, you look at the dividend. How much are they paying in dividends? Now, if you look at the dividend, it's $7.2 billion. So $7.2 billion in dividend. Their free cash flow is around $9.5 billion. That would leave them around $2.3 billion in extra free cash flow for them to pay down the debt. Okay, now we look at the debt maturities, which is, again, I'm talking about easy answers. Most retail, they see high debt, they skip it. But look at the quarterly report or look at the annual report, check at the maturities and see if the maturities are, too close or there's something crazy. Now, if I look at Pepsi, they have 3.2% interest and it's due this year, $4 billion. $4 billion. The next year, they have around $3.9 billion. The year after, 3.3, 3.2, 3.2, nothing crazy. And from now to 2029. Now, they have $2.3 billion in free cash flow every single year. It doesn't really cover the debt obligations, right? But the company also has, if you remember, around $9.2 billion in cash. So they have $9.2 billion and they have $2.3 billion extra every single year for them to pay down their maturity debt. They don't have anything crazy like 10 or 15 billion due in 1 year. So their maturities are really good. And most importantly, they have a good credit rating, which means Pepsi can refinance the debt. So the truth is the debt really a concern with Pepsi? Of course, it's not a concern. Pepsi will never go bankrupt just because it has some debt. I mean, common sense, guys, They can refinance it, they can do so many different things. But skipping a stock just because it has a lot of debt, if that's your strategy, that's fine. But it's normally a mistake not to look at their ability to repay the debt and to look at their ability for them to refinance it if they have a good credit rating and if they have a predictable business model. Now, if you're buying a boat company and the boat company has a lot of debt, it's cyclical, that's very, very risky. If you're buying, a gold miner has a lot of debt, that's risky. They shouldn't have that. But a company like Procter & Gamble, such companies, Adobe, if they do have some debt, they have 95% recurring revenue. They should have a lot of debt. And they would be dumb not to have a lot of debt. So some business models should have debt, and it would be a big mistake to skip them just because it has debt and not look at their ability to repay it or even refinance it. Okay, now this is the last one, and it's also, you could say, a common one, but it's a trap that most retail investors fall into. And this is mainly the GAAP and non-GAAP EPS. So if you look at something like Datadog, that's a major one. It looks, if you look at the 2025 earnings per share, it looks cheap at $1.70, but the GAAP EPS is 12 cents. Look at this massive gap between GAAP and non-GAAP. 204 is non-GAAP, GAAP is 36 cents. This is a massive difference between GAAP and non-GAAP. Now, why is there such a massive difference? It's mainly because of stock-based compensation. Stock-based compensation is $570 million. Net income is $183 million. They adjust for stock-based compensation in non-GAAP. That's why their metrics looks high. But in GAAP, they have to include stock-based compensation, which is the real metric, and it would put their earnings per share at a much, much lower level. So in this case, Datadog has a lot of stock-based compensation, and for me personally, I would normally skip it. Now, if stock-based compensation is going down over time as a percentage of, you would say, net income, or even as a percentage of cash from operations, then I would consider that it's getting better, at least, like with Palantir, it got better over time. But with Datadog, I mean, to me, I would never invest in this company just from me looking at how their financials are structured and how much they have in stock-based compensation and the massive gap between GAAP and non-GAAP EPS. So that's a major one. And anytime I see such a massive gap between the two, I tend to skip the stock because of massive stock-based compensation, which could cause dilution and it could cause many different things. It's really ugly. It's the enemy of long-term investors. So for me, Datadog, for example, I wouldn't even touch it because of the massive gap between GAAP and non-GAAP, and that's due to stock-based compensation. And if you guys want to learn a little bit more about how to value certain stocks, how to do certain things, I share everything I do, all videos and everything in my own group. This is the link if you're interested. But thank you again for watching. Not financial advice. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.